Hello everyone, welcome back to Just Invest Today. And in today's video, we are going to talk about something very important because a lot of people don't realize actually where the returns are coming from. Yes, how are you making your returns? Where are they coming from when you put your hard-earned money into an investment? You have to get this concept down into your mind because it's so important. Because a lot of people just invest in these stocks or these companies and they don't know, how am I going to really make these returns? So in this video, I'm going to talk about it. First, I'm going to be showing you a video of Jake Taylor talking about where your returns come from. Then I'm going to go to John Huber. He did an amazing interview talking about where do your returns come from. Then we're going to go to Frank. If you don't know Frank, he's an amazing investor. He has a YouTube channel. He's on Twitter. Go subscribe to his Twitter. He's always providing amazing content. And we're going to talk about where do your returns come from because it's super key. If you want a 10x, you want a 5x, especially it gets you to actually think, yo, where am I investing in this company? Where is it at in its journey? Because that's going to kind of change your decision on if I'm going to invest in this company or not. So let's get into this video.
And, where do returns really come from? Like, that's what we're going to sort of break down right now. And you could go back to sort of Benjamin Graham's time period and look at return on equity impacting changes in book value, and then a multiple of book value plus a dividend will give you basically like what your return could have been. But today we use more earnings-based things, so you have to do a little bit more. You can do a little bit more decomposition than what Graham might have done, and so.
Isn't that crazy how things change so much? Like, is there going to be another iteration of where our returns come from? Since back in the day, it was all about like book value and dividend growth. Like, can you see something different in the future? Like, that's just speculating, but it would be honestly very interesting. Let's continue.
Really, you're looking at the change in earnings per share, which we can then decompose into the change in the sales and the change in the share count, multiplied by the changes in the margins of the company, times the multiple, plus the dividend yield. So we have this sort of equation that holds true and will tell you exactly where returns came from within a business. And it's
So that equation is super key. Like, people don't realize how important that equation is. So if you can see your company growing in all of those aspects, your returns are going to be like insane. If your sales is growing, if it has dividends, if it's buying back shares, if it's increasing margins, like if it's doing all of those things, like can you imagine how amazing your company is going to turn out? Plus multiple expansion, like it's insane.
The fundamentals, how they're changing, the multiple, which is the assessment, the sentiment about those earnings, and then a dividend yield, sum it all up, and you sort of get where your returns came from and where they might come from in the future.
Yeah, I think like if you think about your returns, to just think about it in very sort of common sense terms, your return in a stock as an investor, your return in a stock is the product of a few very simple factors. It's three simple factors, really. It's the earnings growth during the time that you own the stock. It's the change in the PE multiple during the time that you own the stock. And it's the change in the shares outstanding during the time that you own the stock. So if you own a stock for 10 years and the stock goes from, let's say, 15 times earnings to 30 times earnings, then you get a 2x return from the multiple, right? The multiple goes from 15 to 30, that's 2x. And if the earnings double, if they grow 7% a year over 10 years, that's a double. And so you get a 2x on the earnings growth. And so 2 times 2 is 4. So you get a 4x right there. And then if the company bought back half of its shares, then you might get another 2x on the reduction in the share count. And so, you could earn an 8x return in that simple example just through a combination of those three factors. And so the trick with investing is getting those three engines to be working in your favor. And that's why valuation is sometimes ignored in real rampant bull markets. But
so remember, you have to get those three parts of the equation going for you to actually generate these returns. Remember, earnings growth, multiple expansion, and the reduced share count with buybacks. Get those three things going and your stocks are going to explode. Like, look for companies that are doing these things. You can always look at their financials, look at if they're buying back shares, look if they're starting from a low base, like they're starting from a lower PE. Because like, think about it, if your company's already selling at a 40, 50 PE, what's the chances of that multiple expanding? Like, which can sometimes provide a lot of your returns low key. So just be aware of stuff, or how much are they buying back shares, or are they issuing shares? Like, is the net income actually growing? Is it declining? Like, think about those factors when you're thinking about buying into a company.
It's always critical to think about if you're a long-term investor, because the price you pay today is going to have a direct linkage between the price you pay today and your ultimate return as over the course of the time that you own the stock. And I can give you a simple example. I was looking at Domino's Pizza recently, and it's not a stock that I own, but it's one that's on the watch list. And that stock has grown its earnings at 5x over the last 10 years. And it's one of the best stocks of the last decade. And so it's an interesting case study, but I think the stock has returned about 12x, even after a recent decline. It's returned about 12x over the last 10 years. And so that's north of 30% a year. So it's been a phenomenal stock. And if you think about those three factors, you can easily see that if you bought the stock 10 years ago, you paid 20 times earnings. Now it's 30 times earnings. So you got a 1.5x there. The earnings went up fivefold. They went from 100 million to 500 million. So you got a 5x there. 5x times 1.5 is about 7.5. And then the rest of your return came from the fact that they bought back 40% of their shares. And so there's 60% of their outstanding stock left now that there was 10 years ago. And 1 divided by 0.6 is about 1.6. And so you get a 1.6 multiplier on the buyback, which simply means you have a 60% greater ownership of each share that you own, as 60% greater share of earnings. Those three simple factors, 5 times 1.5 times 1.6 is about 12x. And so that's what you want to think about when you're thinking about investing is, if you pay 30 times earnings, is it going to go to 60? Probably not, right?
Look at the companies that you own. Like, do they have a long runway for that multiple expansion? Do they have a long runway for that net income? And you got to think about this too. The multiple expansion is not going to contribute to a lot of the actual growth in the company in the 10-year, 15-year period. It's usually going to come from the revenue growth, the net income, and the share buybacks. So keep that in mind. Usually multiple expansion is going to really affect your company in the short term, kind of short to midterm. So if you don't follow Frank, please follow Frank, because he breaks this down perfect, exactly kind of like what John Huber said, but he put it in words and he kind of broke it down nicely. So follow Frank Investing on Twitter. Let's read through this thread that he actually wrote. This is like in May. So Warren Buffett's Apple investment. In early 2016, Warren Buffett, Berkshire Hathaway began buying shares of Apple at $25 per share adjusted for the stock split. Apple shares are now worth $157, which is a 6.3x return in 6 years, or a 36 annual return. So we all know Warren Buffett killed this investment. People are saying this is one of the best investments like ever. People are saying, and especially for Warren Buffett, you can kind of put this in that bucket of Geico maybe. Like, this is huge returns, even though the Apple kind of story hasn't played out like Geico, because Geico's been running for 10, 20 plus years, and Apple is just kind of beginning in his investment journey when it comes to Warren Buffett. So let's start this off. Buffett increased his stake in Apple over the 6-year period. He even bought shares recently as Q1 this year. Berkshire owns slightly over 5% of the total shares outstanding. The Apple position is now worth $160 billion, 47.5% of Berkshire's holdings. That is concentrated. That's crazy to even think about. Let's take a look at what drove the 6.3 returns for the Apple over the 6 years. In early 2016, Apple was trading at a 10x earnings. Today, the PE is 25. Therefore, the multiple expansion contributed 2.5x of the returns. Apple's earnings when Buffett first purchased were about $60 billion in comparison to the trailing 12 months earnings of $120 billion. Earnings growth of 12.5% over the period drove 2x return since their original investment. 12.5%, 12%, not that bad. Buybacks were another key driver of Apple returns since 2016. They went from 21 billion shares down to slightly over 16 billion today, which is about a 21% reduction in the total share count. Buybacks drove 1.2x of returns. Of the 3 key drivers of shareholders' returns for Apple since 2016, 2.5x came from the multiple expansion, 2x from the earnings growth, 1.2x from the share buybacks. So you can just see right there the returns that Apple gained and what contributed to Apple's success if you invested since 2016. And if you invested earlier, you're going to see kind of what contributed most to Apple's success. And we can see that multiple expansion contributed a lot to the actual annual growth of Apple's stock price. So guys, take from this what you want. I am telling you that this is key information. This is super important, especially if you're on this investment journey, and you should be if you're watching this channel. So guys, please like this video, subscribe to my channel, and I'll get back to you in the next video. Peace.